everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. Hope everybody had a great weekend and are adjusting to the time change here in the United States, at least. Luckily, days will continue to get longer, so that is kind of nice, but it's a little bit of an adjustment. We're going to jump right in here on the two things that grabbed my attention recently. The first is that it's getting hard to deny that a new Cold War, appears to be brewing or breaking out, as the U.S. Appears to be effectively forcing the world to basically pick sides. Whether you're, and what really grabbed my attention was the increased cadence of U.S. conversations or suggestions, or in some cases threats, against the UK regarding Huawei, against Italy regarding the Belt and Road Initiative, regarding U.S. asking France and Germany to sail some ships in the Black Sea to provoke Russia, the U.S. Floating the trial balloon of charging allies cost plus 50% to host U.S. troops there, etc. You've seen Senator Marco Rubio, tweets on Venezuela. Secretary Pompeo tweets today on Maduro, and so there's this cadence of much more that is rising rapidly, and so that's one thing that has really grabbed my attention. Brings me to the second thing that's grabbed my attention, which is don't get siloed as you're evaluating these things. I think it's critically important not to get siloed in your perspectives, and by that I mean, in the first Cold War, U.S. policymakers and corporate execs didn't offshore a quorum of U.S. productive capacity to the USSR in order to save 30% on labor costs, and then proceed to leverage their own balance sheets, and consumers didn't have the leverage balance sheets at record highs at the start of the Cold War. And so, to me, I'm fascinated by the level of complacency regarding the financial fallout as it relates to everybody in the world. This is not just a U.S. or just a China thing. The complacency regarding the financial fallout of U.S. Political moves, the complacency remains very, very high, which is surprising to me. And when I say siloed, what I mean by that is I've been watching a lot and reading a lot over the weekend. The geopolitics people are really focused on the geopolitics, and the financial people are really focused on the financials, and the economics people are focused on. But what we're really looking at here is this sort of confluence of all three, where I think it's going to show up. And it's part of the reason we founded FFTT, actually, and we saw this siloing of perspectives leading into 2007 and 8, and it seems like it's happening again. And one interesting area that we've seen some warning regarding it, or a symptom, is the BIS last week sounded an alarm on corporate, what they call the corporate debt pileup, which is over half the U.S. investment grade market, or about $1.5 trillion in investment grade debt, is rated BBB, which means it's one downgrade from being rated junk. And so you have anything go wrong anywhere, and you're going to have $1.5 trillion get downgraded to junk, which creates potentially some asymmetric dislocations. And so again, what could cause that? Any kind of slowdown, anything regarding trade war, etc. So I would just encourage you not to get siloed, and make sure you're really trying to put the perspectives of both geopolitics and economics together, because I think they're really going to drive. That's an important way to look at things to drive investment returns as we move through this year and into next. Speaking of geopolitics and economics, a couple questions from last week I'd answer real quick before opening up the floor for questions. Question from last week from CC. He said, ultimately it could be said that it comes down to the superior military. For example, who will Saudi want military protection from, and whose equipment? And that is the crux of the petrodollar deal. This is the elephant in the room to any talks. At what point does Saudi making oil sales deals beyond the dollar and then not buying treasuries potentially upset USA hawks enough? And then what happens next? And I think it's a great question. It's the right way to be thinking about the combination of geopolitics and economics. And I think ultimately, I think if you look at the relationship between the U.S. and Saudi over the last, call it 3 years, there have been some changes that would suggest, perhaps under the surface, some tensions regarding something. So, for example, 3 years ago, or just short of 3 years ago, remember, all of a sudden the United States was willing to talk about sanctioning the Saudis over the Saudi hijackers' role in 9/11. There was legislation that Obama said he would veto, but it came out of Congress in 2016. For a lot of years, that was just something you weren't allowed to talk about or bring up in Congress or what have you. So that hinted at some issues. Then, of course, the purge in late 2017 was particularly of note in terms of just speaking to tensions. And then I think too, when another big clue was when you saw the Saudis said they're considering buying Russian S-400 missile systems. Again, the real politic of it is that the U.S. wanted Assad out. Assad had S-300s, and Assad is still in Syria, and the U.S. is, depending on the week, coming or going. But the punchline is Assad is still there, still in power. And so, these are the types of clues where you're not going to, I don't think we're ever going to see a headline, hey, they're doing this or they're doing that. But these little clues kind of come by, and I think it's important to really put those pieces, those pieces into the mosaic. So that's a great question. Second question is from David. He said that I heard in my interview that I've been going to physical gold. I was wondering what I'm buying. I buy bullion coins, American Eagles, Canadian Maple Leafs primarily. Also asked if I'm buying silver. I actually bought silver in '08, sold it in 2011. Actually, it was one of my best sales ever. Sold it all above 40. But actually, for the first time since that sale in 2011, last year I bought some silver. Actually, sold some Bitcoin around mid-year and bought just a small amount of silver. But I think it's to me interesting. So I'm going to leave it at that. Let me see. I'll take a couple more questions here. Hi, Michael. When Powell cuts 25 basis points a meeting, or back to zero in one fell swoop? I think they start small unless there's some really big blow-up. I would think 25 basis points if they needed to. I don't think you'd go back to zero in one fell swoop. Let me see, what else do we have here? Should be some more questions coming online here. It is interesting. We did see the Wall Street Journal had an article today noting that the U.S. and China are close to a currency deal, which is interesting. Not that long ago, I was called crazy for wondering why Treasury was involved in a trade deal. Historically, Treasury, the purview of Treasury has been the dollar, and so it led me to think there was at least some component of an FX deal. There were comments 2 weeks ago or 10 days ago from Lighthizer that very much this is about a currency deal, and so I think it's an important article to take a look at. Let's see. Hi, Trueheart. What's a percentage composition of your recommended portfolio for now and time horizon? Why not 100% gold? Look, I think gold outperforms. Look, and I think I've said this to people before. Gold is a useless asset for about 99% of the long economic cycle. If you go through all four turnings, right, 80 years, if you will. But for 1% of that time, maybe even a little less, gold outperforms all. When you have a global sovereign debt bubble and the bubble bursts, then gold outperforms pretty much everything. It's the ultimate base money. And so to me, I think, you want to own some gold. I think you want to own, I would never put 100% in anything, but I think you want to put as much, within reason into gold as you understand, right? So 5-10% to me is not a crazy allocation for gold. But again, I would want to own, physical form so I don't take any credit counterparty risk. Hi, Super Bubble. What replaces globalism? I think you're going back. I think you're re-regionalizing. It looks like you're going back into some sort of multilateral system, multilateral commodity pricing, to the extent that the U.S. and this ties into my point about being cognizant of not getting siloed. To the extent the U.S. wants to force the world to make choices about us or them. I understand the geopolitical strategy to that. What I'm cautioning people about not getting siloed about is that, corporate debt, consumer debt, sovereign debt is sitting at all-time highs pretty much across the board, and I would guess probably about 0% of that debt across the board was taken on in the expectation of deglobalization and a potential Cold War. And so, that would suggest, that, spreads will have to rise secularly if this is the geopolitical strategy we're going to pursue. And if spreads are going to rise, it's not good for equities. And if it's not good for equities, it's not good for the global economy, period, through the U.S., where, we've noted over and over that, equities at 55% of GDP effectively are the consumer economy. They're the marginal driver to a consumer economy and tax receipts. So let me see here. In light of Draghi's recent move, what has your view on dollar changed in the short term? I guess in terms of, I'm still secularly bearish on the dollar, but as we noted in Real Vision back in January, as we noted in Macro Voices 2 weeks ago, in the near term, we remain bullish on the dollar. That stance has been more tactical, of course, but ultimately, what we're seeing on the economic slowing front and then the global trade front are both dollar positive, no question. Hi, Doug. Can U.S. lower the value of the dollar without gold rising? Something in the world soon break that. I don't think they can. I suppose mechanically it's possible, but if authorities are trying to communicate that the dollar is weakening and gold doesn't rise, they're not going to have any credit. That message is not going to carry a whole lot of credibility really anywhere. And so I just don't think it can happen. But obviously, I've been wrong about stuff before. So, but I really think that it's something they would need to to convey that message to markets. Currency deal good for yuan, for gold, rising yuan. Hi, D. Dobell. Yep, I would think it would be. Ultimately, to me, the currency deal, I think has to have, I think the U.S. wants the yuan up. I think the yuan, the Chinese probably wouldn't mind it, but for one key thing, which is they cannot have the dollar go down, because if the dollar goes down while their energy bill is all still denominated in dollars, they're going to put themselves into a current account deficit, and they are going to a dollar devaluation will cause a yuan currency crisis, which is counterproductive in nobody's interest. So the first thing you have to do is sort of this separation of church and state, separation of dollar and oil, and you have to grant the Chinese the ability to price oil and energy imports in their own currency across the board. And if you can't, if they can't do that, they're not going to agree to a deal. It's not going to happen, because you're basically asking them to destroy their economy for you, and they're not going to do it. And so ultimately, I think if we get some sort of currency deal, I would think you'd see yuan up, gold up, dollar down. And under that scenario, that's a really bullish scenario. I'm not optimistic still that we will get to that point without more disruption in markets and possibly geopolitically. But I do think that's the end game, and I think that will ultimately, we saw in 2017 a 12% decline in the dollar. It's really good for everybody. We came into 2018 with coordinated global growth, and that was not coordinated global growth. That was U.S. dollar down 12%. Because remember, everybody's short dollars. Everybody's short dollars, and the dollar goes down, everybody wins. So you basically are giving yourself a 12% pay raise if the dollar falls by 12%. You're going to go buy more stuff, and that's what happened in 2017 into 2018. And the reverse of it's happening, basically since April of last year. Let's see. Hi, Mike. Why did Draghi state he'll buy anything but gold recently, in my opinion? It's a great question. He said it back in, I think it was 2014. I don't know. I have seen informed speculation. There's something called the Central Bank Gold Agreement, where European central banks in particular said, hey, gold is still an important part of the reserve system, and we won't sell any more than 400 tons per year in aggregate. That was first signed in 99, re-signed every 5 years after. It's due to be renewed again this year. I've heard informed speculation that there was a sort of non-public portion of that said that they would not only limit sales, but they would not buy. I don't know if that statement, "I'd buy anything but gold," was simply a nod to the non-public portion of that statement. That's quite frankly the only rational is. I'm going on informed speculation here, so I laugh when I say rational because it's a stretch. But that's the best thing I can come up with, and you're asking for my opinion, so that's that's sort of how I've thought about it. Hi, True Art. What's your take on the counterparty risk on knowingly fully allocated ETF like PHYS? You know what? I like PHYS relative to, say, a GLD. I've read the prospectuses of both, and you know, in the case of GLD, you know, there's force majeure language in there, which I'm sure, you know, which I've been told is boilerplate, but it's there at the end of the day. Whereas PHYS and excuse me, in GLD, it still says you can redeem if you have 100,000 shares, which is at today's price is about $12.5 million. Contrast that with PHYS, which the prospectus says if you own enough shares for the equivalent of one London Good Delivery bar, or call it 400 ounces, then they will be happy to redeem your shares for that London Gold Delivery Bar, London Good Delivery Bar, which is a much more reasonable number than the $12.5 million bucks. I mean, it's still, you know, 400 ounces, right? So that's what, $480,000, something like that. But it's at least a more reasonable number than $12.5 million. So. That's my take. I mean, I still prefer physical gold coins for retail investors over any of the other instruments, but I understand liquidity and ease of holding, etc. issues. Hi, Michael. Comments on gold backwardation and falling GLD holdings. I've not seen the gold backwardation. I know sometimes you do get some funny stuff in the futures markets as you get on COMEX as you get close to the end of the contract rolling into another contract, and so I just don't know how much of it is that relative to anything more structural. I just hadn't looked at it recently. Regarding falling GLD holdings, you know, to me it's interesting. You've had, I mean, 51 odd tons GLD has lost since Powell reversed course. It's sort of interesting. You know, if only you would expect the opposite, right? In terms of you'd expect gold and GLD to rise. So, you know, I don't know where did that GLD go. I have my suspicions when you look at, you know, China buying on an official basis, buying another 11 tons last month, etc. But I think it's noteworthy, and so, you know, worth watching. So, all right, everybody, looks like that's about it. I am going to get jumping here. Going to pitch some batting practice to my middle boy before the end of the weekend. So, thank you again to everybody for jumping on. And as always, check out FFTT-LLC for things we're up to, etc. And look forward to chatting with you next Sunday night. Thanks, everybody.